leading indicator. So first of all, my name's Tony Peterson. I've been, as you can see, we've been doing this. This is our 10th year now. We've won a number of awards for our trade room and our indicators and our trading system. I started out as a struggling trader. Had some really kind of cool things happen, which turned my trading around. And I've actually, well, that says 9 years. This is an old slide that should say going on 11 years now. I have become a trading educator and a system developer. I developed indicators to help teach what I had already figured out how to do. I had a group of friends that we were all trying really hard to learn how to trade, and we were kind of trading together, and the next thing you know, I keep calling out trades and they keep winning, and they keep saying, what are you doing? And so I had to start teaching them what I was doing, and that's how the whole thing started. So that's how I became an indicator developer, and subsequently what you see today. So we're going to talk about divergence. Divergence is a real game changer for us. So if you don't know what divergence is, the definition of divergence that you can get from the Investopedia or something like that is that when a price of an asset and an indicator, index, or other related asset move in opposite directions. Okay, so that's really what you want to know, is when they're moving in opposite directions. Okay, so we're gonna, oops. So this is what's used, what we use in what we call technical analysis. Okay, this is whenever you see an indicator, it's using technical analysis, which means that we're taking historical data and we're studying that and saying historically, if this happened this many times last time, or this percentage of times, then it's very likely to happen again under these conditions. Okay, so we're looking at what we would call maybe positive divergence, or you call it bullish divergence, and that's going to be when price and an indicator are suggesting two different things. Okay, price here is setting a lower low. Price here, momentum here is setting a higher low. Okay, so they are no longer running together, which is most typical. Most typically, they're going to run together, and then we have negative divergence, which would be the opposite of that. Okay, this is when things are not running typically. That's where the key is. All right. So to trade divergence, price, and the swing highs and swing lows, must move away from something. And for us, that something is momentum. Okay? Momentum is, there's a number of ways that we can read momentum. Okay, most of those ways are going to be in an oscillator, something that looks something like this. This particular oscillator, I think, is the RSI, or the relative strength index. But if we have increasing buying momentum and decreasing selling momentum, okay, we're going to see an upswing. And then conversely, the opposite, we're going to see a downswing on this oscillator. Okay. Now you notice this oscillator has certain points on it where you can see that the oscillator has a swing high or swing low, just like price does, right? So let's look at this. There's a lot of different algorithms for different momentum oscillators. Some of them are very complex, some of them are very simple. So to show you what it is that we're actually measuring with a momentum oscillator, I'm going to take the most simple algorithm out there and show you how momentum is being calculated. And this will help you to understand what's going on when we're looking for divergence. Okay, so I find that this was very important and very enlightening for people to understand. It's not just a wavy line on the screen. There are calculations going into that are important for you to understand. So we're going to take a very simple algorithm, and this one says that the closing price of the current bar minus the closing price of X bars ago. Okay, that's a very simple calculation, but it does plot a signal, right? Okay, so here we've got our regular chart. Down here we've got our oscillator, which is blank right now. We're going to fill it in with the information that we're going to get provided. Okay, so we're going to say that this was the current bar, right? And we're going to go back 10 bars. And we're going to take the price of this bar, okay? Or the closing price. So the price of this bar was 94.40. The price of the bar 10 bars back, 94.33. All right? So we're going to subtract those. And that comes up to a plus 0.07. Well, that now gives us something to plot. All right, this is our zero line. So we have a point to plot based on that. Okay, so let's take the next bar. Okay, so we'll say this is the current bar. We're going to take the closing price of this bar versus the closing price of 10 bars back. All right, so there's the prices. There's our calculation. Now we're at a 0.06. That's another point. Okay? Now you start to connect these points, you get lines. All right, now let's look at this a little bit further down the line here. So we have the closing price of this bar minus the closing price of this bar. All right, so we're getting a 0.06, same thing. We're going to do the same thing. And you'll notice now we start plotting all of these points, and this is what gives us our swing highs and swing lows. This is how we're calculating momentum using any number of momentum oscillators. There are certain oscillators, like I said, that use more complex algorithms than the one I just showed you, but ultimately they're all doing the same thing. They're using math to figure out where they feel that the momentum is the strongest. And we want to figure that out because not just for divergence, but to understand that where we have momentum traders may be wanting to get in at that point. Exhaustion traders, like what we do, may want to know about momentum so that we can anticipate exhaustion. Okay, so divergence occurs when we have a different slope between the swing high of price and the swing high of the momentum line or swing lows. Okay, so you see that this is higher high, this is a lower high. That is divergence. And why is that important? Well, first of all, here's 7 of some of the most typical momentum oscillators. We have an indicator called the Super D. Not talking about it a lot today, but we have one indicator that has all of these inside of it. Okay, and I will show you a little bit about that later on. All right, so let me make this a little bit more simple to see how it works in trading. Okay, I have a very, very simplified chart here. Let's call this a trading chart, and this is just our regular bars, and this is price, okay? This line is going to represent momentum, okay? Typically, price and momentum are going to run together. They don't diverge from each other on a bar-to-bar regular basis. They run together. Everywhere you look along the lines, you're going to see that price and momentum are doing the same things everywhere along that line. All right, now, here's where it gets fun. When price and momentum get out of sync with each other, this is where you'll notice that all along this line, you'll see that we don't have divergence, but somewhere along here, we end up having a divergent condition where momentum is climbing while price is still falling. Okay? So that's a very simplified version of what's actually happening. Now here's one of the problems. Okay? Here's what a lot of people have issues with trying to figure out divergence. They want to be able to just look at this line and look at price and know when divergence has set in. But if you're not extremely experienced and practiced at this, you can miss it so easily. If you just glance at this line and the line of price, you're going to notice that it looks almost exactly the same. Price is just kind of drifted along here, and it's just drifted along here. We got a sudden drop in momentum. We got a sudden drop in price. We got this hump up and another hump up here, another hump up, then a drop, price up. Okay, it's easy to miss, but let's take a look at this. So we can look here and we can say, okay, yep, no divergence. We're setting lower lows on both of them. We're setting lower highs on both of them. Whoa, boom, right there. See how easy that would be to miss? Here's the kicker. When momentum and price get out of sync, price will almost always follow momentum. So what that means is, you notice that momentum is going up. Look what happens to price when that condition diverges right here at this point. Look what price does. The most important thing for you to get out of this event is that when momentum turns before price, price will almost always follow momentum. That's why it's a leading indicator. That's why it's so powerful. So why don't we use it more? Typically, it's been extremely difficult to train yourself to see and understand divergence. Okay, there's all different kinds of divergences. They all work the same way, though. They all give you the same results. You want to know when price and momentum are going in different directions. And when they are, you're going to figure that price is going to follow that momentum. So typically, you're going to get indicators that look like this that will, several bars after the fact, draw some lines, and your chances are you're still going to get confused about all of these lines on your chart and trying to figure out when is the right time to trade divergence. Okay, so there's any number of oscillators that you can use. So you're going to take up all this space on your chart trying to figure out where the divergence is happening. So if you look at this chart and then look at this chart, it's the same chart. Okay, it's showing the same divergence signals from the RSI oscillator. These are our divergence signals. They print on the open of the bar that they're on. Notice we printed a divergence signal, price dropped. Printed a divergence signal at the open of this green bar, price shot up. Printed a divergence signal on the open of this red bar, price dropped. All right? So we've taken something very complicated. Now the last one was the RSI divergence. This is MACD divergence. Same thing. It's kind of little though. You can hardly see these little dots here. We got a dot here, dot here. It's actually a little diamond, but it does the same thing. It's the same algorithm, but we use a different momentum oscillator. So this is how we started with divergence. First was with the flash, with that lightning bolt, using only the RSI. And it was killer for us. It was a real game changer when we added divergence, and make it real easy to see and understand. So then we thought, well, this is so good. Let's use the MACD and let's see how that does. Well, that worked awesome too. So then I thought, all right, here's what we're going to do. We're going to create a new indicator, and it's going to be a single indicator, but it's going to use 7 different momentum oscillators to tell us when we have a divergent condition in one or all of those oscillators. Okay, so you can, inside the indicator, choose which oscillators you want to use, choose when the signals are printed, choose whether the one or all of them need to be present in order to generate a signal. You've got all kinds of flexibility inside of this Super D. 7 different momentum oscillators to choose from. Okay, and then you can just see on there, it'll just say how many of those oscillators are generating a signal, and then we have a little toolbar that tells you which oscillators are generating that signal. Okay, very powerful. This has also become part of our favorite indicator called the Rockstar that we'll talk about here at the end. So as far as trading divergence goes, we have a lot of people that see our indicator or our divergence indicators, and they immediately start getting really excited because they work so well. You just want to jump in every trade, but you have to really think about what's going on and understand the markets before you just jump into every trade. You also get a lot of divergence during chop, okay? And it will catch you off guard when, you know, price is moving really well and then we start getting into a choppy condition. If you think about it, during chop, what's really going on? Price is just kind of drifting in a tight range, okay? Well, so is momentum. It's just kind of drifting. There's nothing driving it. Think about a boat on a lake without the motor running. It's just drifting. The more you apply the power to the motor, the more control you're going to have and understanding on where that boat's going to go. And this is kind of what's happening with chop and with divergence. So you're going to get a lot of divergence during chop. So you got to know when to trade divergence, right? So we've developed a system to understand when is the best time to trade divergence. And this system uses what we call confluence of non-correlated indicators, meaning we're getting all this information that's coming in all at once that all suggests this is a good place to take a divergence trade. Okay? So we have divergence as one of the confluence indicators, momentum or velocity, exhaustion, or the potential for exhaustion. We use volume spread analysis to understand when the right kind of volume is coming in. We do typical tape reading, and we look at relative order flow. All of those combined with divergence gives us an extremely strong trading opportunity. Okay? So how do we do that? Well, first of all, we're going to have our momentum indicator, well, our velocity indicator, which is this this white strip, and this is telling us there's a lot of price changing going on inside of that bar very quickly. we're looking at a push on these on all of these bars. We don't want to be trading in a market that looks like this, but when it starts looking like this, we start getting very interested, and you'll notice that the bars go from a black to a gray to almost white. The lighter the bars get, the more likely it is that exhaustion is setting in. Okay, so when we get a strong push like this, we know it cannot be sustained, right? We know that exhaustion is going to set in. Price never moves in one direction like this for very long before it has to pull back. And there's a lot of reasons for that. People getting stopped out, people taking profits, the market's getting overwhelmed with supply when there's not enough demand. So there's all kinds of reasons for this happening, and we know it's going to happen. Okay, so we're looking for exhaustion to set in. So when you see exhaustion, a strong potential for exhaustion, this is a good time to be looking for divergence. Okay, so we've got another indicator that we use, and it's a very simple overbought and oversold indicator. Okay, so overbought means that price has exceeded the upper and lower extremes of an oscillator, which could be the RSI or the CCI or the stochastics or whatever you want to use. We use the RSI for our OBOS, what we call OBOS, overbought, oversold indicator. When price gets overbought or oversold, means it gets outside these extremes, it's getting exhausted and it's going to want to get back inside these lines. Okay, so we're looking for areas of exhaustion. And again, so we're going to, when we see this, rather than putting this oscillator on the screen, we're going to get rid of that, and we're just going to print an outline on this bar and on this bar that says we're overbought or we're oversold. This, when price is overbought or oversold or exhausted, is a good time to be looking for that divergence signal. Okay? So we've got volume coming into every bar, right? If volume is being manipulated, we want to know. Okay, the smart money, the big boys are constantly manipulating the markets. If they're manipulating the markets, they're doing it for a reason. And the reason is they want to create a response from us typical retail traders. Okay? Now, we're going to use volume spread analysis to understand what's going on inside every single bar, every tick that comes into every single bar. And we want to understand not just that we have a high-low open-close situation, but how that volume came in and how that volume can tell us what's likely to happen next. So let's look at these two charts. You've got these two candlesticks. You've got two identical candlesticks, right? They're exactly the same. If you look at a static chart, you will notice all of these candlesticks, and the only thing you know for sure about those candlesticks is the high price, the low price, the open price, and the close price. Even though you may have had hundreds of ticks come into that bar that formed that bar, those are the only 4 points that you get from looking at a candlestick. So what I want to know is, how did that candlestick form? Okay, so if you look at this candlestick on the left, You could say, you know, it's got a wick on it. Don't worry about that. You could say price came, or volume came in, the ticks came in, and generally speaking, they pretty much came in down here and went up and closed here. Okay? Nothing really specific or dramatic happened during that bar. Same looking bar, but we get something else happened here. Price open, it climbed, it hit got near the top, and then all of a sudden, up to this point it was all buying, and then all of a sudden you could see where the sellers were just sitting up in this area waiting for the buyers to get there. Now, the buyers don't necessarily know that's happening. They're just happy as crap buying, and people keep jumping in. Oh, price is going up. I'm going to keep buying. All right, and then the sellers are here waiting, and the buyers and sellers start fighting with each other. Price starts churning a lot, so you get a nice push up, and then all of a sudden, whoa, 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 whoa. All right, this is where the sellers who are not exhausted, the sellers have been sitting and waiting. They've been holding on to their money. They haven't been just going crazy. They're waiting. They've been quietly waiting for these buyers to be getting exhausted. Okay, they've been buying. Okay, getting kind of tired, been doing a lot of buying. That's when the sellers jump in. Okay, so another way to think about that, you got two fighters here. We call them buyers and sellers. This guy, he's been buying, and he's been buying for a long time. Or this guy's been fighting all night. He's, you know, this is a tournament, and this is his third fight of the night, and he finally gets in the ring with a guy who's just been sitting and resting. He hasn't fought yet. He's been resting and just waiting to jump into the ring when it's his turn. Okay, this is what's going on when we're reading every tick that comes into the bar. When we get the right kind of price action, the right kind of volume coming into that bar, we're going to generate what's called a pullback alert. Okay, and there's an awful lot of technical analysis going into these little dots right here, because all we want to do is show you that there is an opportunity here. We don't want to you don't have to have all of the information. You just need the important information for making a decision. This is an excellent place to factor in divergence. All right? Because we know that the buyers are getting exhausted, and then we got a churning activity. The sellers have been waiting up here, waiting and waiting for the buyers to just kind of stumble into their trap. Lots of churning activity goes on here. This would be an excellent place for divergence, to add a divergence signal. Okay? And tape reading. All right, everybody knows what tape reading is, right? The guys used to look at the ticker tape to try to figure out where the big boys were manipulating the markets. Manipulations have been going on forever. They're just more prevalent now because they've been given more leeway to add liquidity to the markets. They've been giving some allowances by the government and the exchanges, although they are limited in what they can do to hide what they're doing. They can be very creative to hide what they're doing. Okay, so what we use nowadays for tape reading is called the time and sales. If you've ever watched time and sales, it's really kind of interesting. These are not orders that are standing. These are orders that got filled and traded. Okay, and you can see these orders scrolling through on the time and sales window. So if you're inclined to sit and watch that, there is a lot of information there that can help you understand when it's very likely that the big boys are manipulating the markets. Not many of us are inclined to sit and stare and try to figure this out. So what I did instead was I created this histogram. I had a theory, and I asked a programmer to develop this histogram for me. And I noticed that when we have these peaks on this histogram that exceed a certain range, we would get what price would stop and turn. Okay, price stops and turns. So we've kind of exceeded this. I think of it like a speedometer. We've exceeded the rate at which the retail traders are likely to be able to trade. Okay, the rate, the speed at which the orders are being processed. If it's faster than retail traders can do it, then it's very likely going to be a mechanical manipulation. Okay, this is what we call our speed tick. Excuse me just a second. Sorry, my throat getting a little dry. All right, so this is an excellent place. Again, an excellent place to add in a divergence signal. In fact, this with our speed ticks, this is what these little white arrows are called. Coupled with divergence was the first thing that really put us on the map. Okay? And that has actually turned into something even better, and I'll show you that in a few minutes. So we have some other order flow indicators where maybe this histogram that I had created doesn't hit the speed limit, but it does accelerate. The speed of the orders being processed accelerates dramatically over the previous bars of the histogram. When we see that, we often see price pulling back. So we've got a number of different indicators to go with divergence. You know, we've got divergence plus momentum plus exhaustion plus our volume spread analysis indicator plus doing tape reading with our speed tick indicator plus the relative order flow. This creates a confluent condition, meaning rather than just trading divergence, and momentum, or divergence, momentum, exhaustion, or divergence, momentum, exhaustion, and VSA, why don't we just trade them all? Put it all in there and say when all of these suggest that something is about to change, then we have a confluent condition. Okay? Confluence is the key. All right? Confluence of non-correlated data like price and volume and order flow and momentum. We also use support and resistance. When they all come together to suggest the same thing is about to happen, that builds confidence. And with confidence comes consistency. Okay? So this is, I've got 10 different indicators right here, all with different data sources suggesting the exact same thing. Something's about to happen. All right, so we've got our momentum indicator, means we've got the strong push. We've got our OBOS indicator that we use the RSI to determine whether price is overbought or oversold. We've got our speed tick indicator that says that the markets are likely being manipulated because there's almost no way us retail traders can do that. We're looking at a relative, that shouldn't say volume, that's a relative order flow. We've got our pullback alert using volume spread analysis to determine what's going on inside every bar. We've got our flash indicator, which is that lightning bolt behind the diamond, which is divergence from the RSI, the McDiver, which is the diamond, which is divergence from the MACD. We've got our velocity indicator, which is anticipating exhaustion. Our FT reset indicator is our major support and resistance. And then we have our high of the day, which is minor support and resistance. So where price is in an area where everything is suggesting something's about to happen. All right, now, so we did something kind of exciting. And to be honest, I didn't really think it was necessary. But it has pretty much changed how we do things. It has made identifying these confluent conditions even easier. So we've got a new indicator that we call the Rockstar. It was called the Rockstar because when we were trading this, when it looked like this, we're killing it, right? And one of our trade room members said, Tony, this trade is a rock star. We used to call this the speed flash. Okay, it's a speed tick and then the flash. So this was our speed flash setup. So eventually I decided, you know what, let's take the best of these. Let's take the Obos, the speed tick, and the Super D, which has the flash and the McDiver in it also. And let's put it all into one indicator. And we're going to call that the Rockstar. So the Rockstar now is a thing that everybody's looking for. This is where the magic happens. At the open of the bar, we're going to print a Rockstar if we have a confluence of those conditions of those other indicators. Okay? We still use those other indicators, but those other indicators give us a heads up that we need to be paying attention. Okay? And all we're doing is waiting for the open of this bar to make our decision based on that Rockstar. Now, you want to come see the Rockstar in action? Come to our trade room. Maybe Connor can put a link in there for our trade room. But if you don't have the link in the chat, here's the link for you, or you can, for those of you that are here attending, click it in the chat. For those of you on video, you'll just have to type it in. Come hang out with us, and I'll show you real time how this works. Okay? We are from 9 a.m. until noon, Monday through Friday, unless it's a holiday. And we trade these 6 instruments. No, we're not likely to be trading the micros, although somewhere down the line I might put 1 or 2 in the room for those people that want to trade micros. I've been trading these minis for so many years that I don't really need to trade the micros, and the cost of the micros is about double. Of course, you can trade with fewer dollars, and it's a much lower barrier to entry. And if that's where you want to get started and work your way up to the minis, I think that's probably a good idea. I think the micros are geared towards those people that have become disenchanted with the unfair advantage that the Forex brokers have over their customers. So I think the micros are to lure those Forex customers over, which I think is a really good idea. But anyway, come hang out with us for 5 days in the trade room and see exactly how we use divergence in our trading. We do have, for those of you that are ready to get started, we do have 4 different special offers. We've got 2 offers on a couple of indicators, the Super D and the Rockstar. And then we've got some bundle packages that we're offering specials on as well. You can go to that link, this link up here at the top, or Connor just put that into the chat. You can copy that link and go ahead and go on over to it and go ahead and get started. If you've got some questions, you'll notice that at the bottom of every page of our website, you see this. There's actually real people sitting there waiting to answer your questions for you most of the time. Sometimes we're not there, but if you leave a message and nobody responds, it actually goes to our support desk, and we pick it up at our support desk, and then we will answer your question. So if you don't hit us, if you have a question and you hit us on the chat and we're not there, then go ahead and we will get back to you. Or you can just email us directly at the support@theintentionaltrader.com, and we'll definitely get back to you. Okay, so those are our specials, and I am ready to answer questions. So I got a question for you, Christopher. I'm happy to answer how many ES trades I average per day. But why do you trade the ES? Or do you trade the ES? We do have the ES in our trade room. And here's why. Because a lot of people like to trade the ES for some reason. I used to be one of those people until I got clued in on what's going on. Hold on a second. I have put the ES in our trade room to entice people to come watch and see what we're doing. We do have it there. I don't even trade the ES because it is so slow. The longer you're in a trade, the more speculative that trade becomes. I want to take an instrument that moves exactly the way I expect it to, and immediately. Kind of think like a bouncing ball, right? To me, the ES is like a bouncing beanbag. Okay? I want a bouncing ball, and that's going to be on the NQ, the YM, the RTY, and then the others, the GCCL, are all going to move much more favorably than the ES. You're going to get a lot more better opportunities on the other instruments. But we have a lot of people come to us and hang out with us in the trade room thinking, well, I just want to see how these guys do on the ES. Next thing you know, they're like, yeah, screw this ES. These guys are all killing it on these other instruments. I should be looking at those other instruments. How many of you, I don't even know who's here today. How many of our regular traders came into the room thinking they wanted to trade the ES and then really don't trade it that much anymore? I know, I've heard from a lot of them that that's exactly the case. 5 ticks. Oh, hey, Eric. 5 ticks. That's it. I want to get in, out, done, put my money in the bank. Where's the safest place for you to be as a trader? What's the safest place for you to have your money? In your bank, or in your, well, yeah, cash, but you can't really trade with cash. In your trading account. That's the safest place to be. So that's where I want my money to be most of the time. Which is why I want to see immediate reactions. I do a hard target, okay? We've got some traders that will trade for a bigger hard target than I do. I used to try scaling. I used to try trailing stops. I found that I developed consistency. I see that consistency is important to you. I developed consistency when I started hard targeting for a small target, and instead of trying to make more and more and more on a single contract, you know, more ticks, more ticks, more ticks on a single contract, I got really, really good at hitting my hard target And when I increased my bank account or my trading account by, I think at the time it was $2,500, every increase of $2,500, I'd add a contract to that same trade and keep doing the same thing over and over and over again. I consider myself a specialist. I have something that I do better than almost anybody else in the world, or I should be better than anybody else in the world, meaning that practice, practice, work, study, practice some more if you want to get good at this trading thing. We have a whole program that teaches you how to do that, by the way, and gives you tools to practice. And a new one that's being released, it's even better, being released here whenever I can manage to finish it, next few weeks, hopefully. Did that answer your question? Any other questions? I know you guys, I see that there's stuff in the chat here, but I'm assuming that Connor and the rest of our folks were able to help you with it. Yeah, we only use the best one, and that's NinjaTrader. We used to develop for a few of the others, TradeStation and Multicharts, but it's such they're so inferior that they can't really keep up with what our indicators are doing. Every time they would come out with a platform update, they would break our indicators, and we'd have to go in and rebuild them. That was TradeStation. Multicharts just never could keep up with what we were doing. They had no idea anybody would want to try to do what we were doing. NinjaTrader has no problem with it. Rinko bars. I don't use Rinko bars. I use time-based bars. I can't stand anything that removes time from a chart, from the data. Time is one of the most critical points of data in trading. And to use range bars or Rinko bars removes time, and I don't understand why people do it. I know they do. They make really pretty charts. I know they have some value for some certain types of trading where you might want to use a Rinko chart as a confirmation type chart or bar chart. But I don't know anybody, doesn't mean there aren't out there, but I personally don't know anybody that uses Rinko or range bars or some variation of the two to trade successfully. You know, most traders that I know of that are successful at trading always factor in time. Time is too important. Ziggy, ask Connor about that. Hit Connor up at the support desk and let him know what your reasoning is, and you know, he can. I'm sure he can hold it for you, but he's going to ask for some sort of commitment from you as well. Yeah, you're the only one too, which is weirdest thing ever. You're the only one. And of all indicators, I have no idea. Neither do the guys at Ninja. They're all just scratching their heads saying, no, this can't be true. It can't happen. It just can't happen. We have licensed more indicators than any other NinjaTrader ecosystem partner by a lot. We have, and we don't do free trials. I mean, we've actually exceeded a lot of the other vendors do free trials. We've exceeded what they do. And the reason I know this is because we broke NinjaTrader's licensing servers because our database of licenses was too big. So I had to create my own licensing server because NinjaTrader's licensing servers couldn't service us anymore. And I finally got NinjaTrader to say, yeah, we've never had anybody ever use that many or have that many indicators out in the field that needed licensing. So we've been around for, going on 10 years now. This is our 10-year anniversary. So as you can imagine, we've got a bunch of licensed indicators out there. Any other questions? 1 minute, Tom. Oh gosh, I don't know. I'd have to go look. I don't remember, to be honest. I don't remember. Connor, do you remember how many licenses we have? We downloaded about a year and a half ago when we were creating our licensing server 2 years ago. We downloaded a list, and that was the last time I looked at the list. It's going to be around 20 to 30,000, somewhere in that range. Now you're going to try to figure out, well, these guys are making all kinds of money, aren't they? A lot. Here's a one thing that you may not even think about. If I have been doing this for 10 years and we didn't have just a whole bunch of happy traders, don't you think you could Google the intentional trader and find all kinds of negative stuff about us out there? Here's the problem. We do get a lot of people emailing us that say how happy they are and they're killing it, and that we've changed their trading form and all that. Funny thing about that, though, they don't post that stuff online. Why? Because they think that if too many other people know about the edge that they have, then it's going to erode their edge. There you go. There you go. And so if you just go and you try, so the best metric is how many negative things can you find out about us on the internet? Googling. I know I can go to a lot of the other people that do what we do, and I can Google them, and I can put the word scam after it, or even just Google them and say reviews or whatever, and I can find just gobs of negative stuff out there on the internet. I haven't done it in a while, but about once a year I'll do it to see if there's any complaints about us, to see if there's anything out there about us that people are saying that that we don't really do what we say we're going to do. And so far I haven't found anything. Any other questions? Thank you, Eric. Any other questions? Happy to answer them for you. All right, well, hit our specials page there. Oh, here's the thing. I trade 5 instruments. Of those 5, some days all of them will be NQ. Some days none of them will be NQ. But on average, between those 5 instruments, I'm going to trade about 6 times a day on average. Yeah, Renji, we do, but I haven't seen them in a trade. We have a lot of people that will buy a package, come in the trade room for a few weeks, and then they don't come to the trade room anymore, because they really, a lot of the people in the trade room are there because you just like to sit around and trade with people. And then some people just want silence. They don't, once they learn the system, they don't really want to listen to me. And they just as soon do it on their own and sit quietly in their office by themselves, which is fine. So we do start to lose touch with some people over time. As you imagine, after 10 years, people get very comfortable understanding the system and knowing what's going on, and they just trade on their own. So yeah, I do know we have had several from Scotland, but I couldn't tell you right off who they are or how they're doing. All right, well, thanks everybody for coming. Come hang out with us in the trade room next week. If you've got any question about our specials, hit us up on the chat or on the support desk. Tom, or whoever it was that wanted to talk about extending the special, Ziggy, talk to Connor and let him know what your circumstances are, and I'm sure he'll try to work with you if he can. All right, everybody, have a great rest of your day. Really enjoyed it. Hope you found this interesting and educational. And I hope we get to see you all real soon. Bye now.